thank you for the introduction to our chairman, also to Nicholas and the Capital Link team. It's great to be back in Cyprus with Capital Link again after a short pause, so thank you for that. As was mentioned, my name is Jasel Chauhan. I'm Head of International Finance at Dickinson and also Head of the Piraeus office. I think probably before I start the introductions, I should probably start with a brief apology. With a session after lunch, then we had interest rates, inflation and sanctions, so if you don't have indigestion now, I'm not sure when you will. But I'm hoping that the finance panel will be a little bit more soothing. There seems to be a lot more capital in the market, so I'll defer to my panelists to help soothe the discussion a bit more now. So just to introduce everyone, to my left we have Michael Burgess, who's an Associate Director at Ascension Finance, Constantinos Milios, who's Head of Shipping Finance at Eurobank Cyprus, Atef Abou Merhi, who's Managing Director at Pelagic Partners, and Andreas Christofides, who's a board member at Safe Bulkers Participation. So I think to jump straight in and try and keep on top of the time, I think what we'll start with is a brief introduction from each of the panelists. I think we've got the advantage of this finance panel having a number of different perspectives, both from banking, private equity, and the investment side as well. So I'll just pass an initial question on those perspectives, what each of the panelists bring to the capital table for shipping, and how they see the finance market developing, whether over the next 12 months or beyond. Michael.
Ascension Finance. Ascension Finance. We have senior secured firstly in debt, which looks very much like traditional bank debt. Our team are made up of ex-shipping professionals, shipping bankers. Most of my colleagues have over 20-25 years experience as ship finance experts. And we've deployed $225 million for 17 vessels in a period of about 18 months. In terms of assets, we are sector agnostic, but we have today focused on containers, dry bulk and tankers. In terms of structure, we are flexible, as expected from an alternative lender. We're flexible to age, employment, LTV and recourse. We traditionally have supported older vessels. We can finance vessel trading spot. Our LTV is typically around 70%, and we don't require personal or corporate guarantees. Our ticket size, the range is between $10 and $50 million, and our customer base are traditionally small to mid-sized ship owners looking to grow their fleet or refinance some of their older tonnage.
Great, thanks Michael. I think that was quite a sales pitch, so Constantinos, you're going to have a lot to live up to next.
Thank you, Jason, and many thanks to Nicholas Bornoris and his team for organizing another successful event in Cyprus. To be honest, I was about to remark that I represented boring, the plain vanilla part of the table, but at this level of interest rates we might be mistaken as alternatives. Eurobank in Cyprus is a subsidiary of the Eurobank Group headquartered in Greece. We've been operating on the island for around 16 years now. We've been following a primarily wholesale model, and based our growth on the presence both of local expertise as well as support, know-how and synergy with our parent group and Eurobank network in the countries where it operates. Of course, co-part of our business is shipping finance. We are traditional plain vanilla lenders working on a relationship model. While within this integrated relationship with our clients, we have the chance to offer a broad range of ancillary services such as transactions, wealth management, private banking, trade finance, treasury products, etc. Whereas by working with us, clients open the door to cooperation with Eurobank in other countries, and particularly relevant for our ship-owning clients are, of course, Eurobank in Greece and Eurobank Luxembourg, together with its London office. We're very proud to belong to this group because despite the fact that the bank is still relatively new in Cyprus, we enjoy a wealth of experience in shipping. Our head office shipping unit has been ranked as the leading, in terms of lending to Greek ship owners and Cypriot ship owners, the leading Greek bank and the second globally. And we draw a lot of support and experience in every aspect, from assessing and implementing transactions in a very efficient manner. In ship lending, we are, of course, we select very carefully our counterparties, and we prefer assets which are common, mainstream, with a more easily identifiable revenue pattern, employment and values at any point in time.
Thank you, Constantinos. And of course, we'll pass down the question now slightly more to the investor side. I would ordinarily, ask about the $1 million question, but I think that the panelists on the end of the table is more of the $100 million question. So, with that introduction, I'll let Atef give his views on capital for the market.
Yeah, thank you very much. Yeah, so as you mentioned, we are from the owner's side. Pelagic Partners is an alternative investment fund manager that was established around 3 years ago by Dr. Niels Hartmann of the Hartmann Group and myself. So we are basically on the other side of the table here from the gentlemen's. We own and invest into a diversified portfolio of shipping assets. Basically, we invest in everything that is basically floating on water, whatever makes sense in terms of numbers, whatever makes sense in terms of investment. We look into. We currently have approximately a fleet of 11 vessels with some new builds, which is focused on the offshore wind, which we will touch upon when we go to the ESG part of the topic. Other than that, what differentiates us between other fund managers is that we have a bigger group around us, and we try to utilize the expertise from the group, whether it's from the commercial aspect, from the technical aspect, in order to get back the best returns to the investors.
Great, thanks. And pass on to Andreas.
Thank you, Jasel. From my side, Andreas Christofides. Thank you for being here today. I represent Safe Bulkers Participations, a subsidiary of Safe Bulkers. As you know, the company is one of the leading operators in the dry bulk space, with 44 vessels and 8 vessels in the order book. Participations, the subsidiary, was established in order to issue a bond, which we did early last year. So it's a 5-year unsecured senior bond issued in euros. It was oversubscribed for 100 million euros, carrying an interest of 2.95%. It was clearly a very successful attempt by the company to access the capital markets, and in order to have more diversity as far as the credit availability is concerned.
Great, and I think that the initial summary from each of the panelists, I think, probably starts to highlight that there's a lot more different forms and sources of capital than there used to be. And probably recall over the last 10 years, sometimes it was difficult to fill a panel, and I think these days there's a lot more choice and options. So I suppose before we move on to financing options and deal types and the different options that are out there, I suppose just some initial overviews which I'll throw open to the entire panel in terms of how they see the available capital. I mean, it seems almost very obvious that there's a lot more capital there's a lot more options, a lot more interest in investment. Is that very much what you're seeing? Is that meaning that for the foreseeable future, certainly in the next 12 months, we're expected to see that availability of finance that perhaps hadn't been there for several years? I'll throw that question open to any takers.
All right, so I'll go first. Honestly, when I graduated in 2010 from my shipping studies, I was thinking, what the hell am I putting myself into? The markets were so bad. Everything basically around us was very negative, and now fast forward 10 years or 13 years later, the market is very kind of different, the dynamics is different. In terms of having more capital around, We have seen this come furthermore, especially through the interest that we have seen in the Middle East. We have touched upon a lot of equity in the Middle East since shipping is quite underinvested in the area. Middle East meaning more on the Arab world as well. In terms of appetite from banks and alternative lenders, we have seen this also grow over the past 3-4 years. It has helped a lot, especially with assets producing some steady cash flow. So after the start between 2010 and 2017-18, there was a dry market. I mean, in terms of equity and debt, it was quite high. A lot of oversupply to digest in the market. But recently, I believe in terms of equity, more on private equity, perhaps on the capital markets, we have seen also quite activities in 2022. But on the private side, whether it's on debt lending or private equity, family offices, we've seen that there has been a lot of activity coming forward given the change of the past 2 years in terms of earnings that we have seen in the market, not just that, but also on the fundamentals that we have over the next 10 years, which is, we believe, in a favorable position.
Right, and Andreas, I just wanted to pick up on one of the points you mentioned. Obviously, with the bond issue, that was also part of diversifying the funding options, and so with that, I'm guessing you're seeing that there are those options out there. There's been a few players in the market that have been able to do the bond, and I just wanted to check your views on that as well.
Absolutely. I think it's important to have access to capital. I think it's important to have diversified access to capital. And yes, as we have seen last year, there were some bond issues throughout the whole spectrum of shipping. So not just dry bulk, but also in the other segments as well. I think what we saw last year, which was a momentum year for the financial markets, and clearly for certain parts of shipping, there has been a growing investor interest, for example, in energy, LNG, in tankers, for example, as well. So yes, there is investor interest coming into that market, and I'm also sure if we look at the profitability of generally the shipping industry, this has been quite high the last 2 years. However, let us not forget, especially in dry bulk, the very difficult decade that we've been through, especially since the great financial crisis. So for us, it was great to really not just access the market, but especially the bond, which was addressed to retail investors in Greece and was oversubscribed. It was a very big vote of confidence towards us, the company, the management. Yes, I think overall, so it's not just, let's say, public credit, but also private credit as well, which is very important.
Great, thank you. And I think we'll start to move on a bit more in detail to how that mix of different available funding is also affecting the market, and I suppose it's closer to a bit more of a pick and mix of different financing options and how those deal types fit together, whether it's a mix of bank debt with private equity, with more structured transactions as well. And ultimately, I think probably over the last few years that different types of financings that were perhaps considered alternative, even the rise and to some extent dominance of things like lease finance and Chinese leasing, as well as European and US leasing. But I suppose I want to shift the question and the discussion to how all of those deal types fit together. I'll pass the next question to Michael in terms of ultimately what would have been considered alternative finance simply from not being financed that wasn't coming from a bank. It's certainly a lot more mainstream these days, and how you find from that different perspective fitting into the capital market. Obviously, you mentioned that there's a lot of flexibility and perhaps more flexibility, and how that fits in the market, as well as whether that's a mix of adding equity transaction, joint ventures, and those aspects as well.
I think the point I really like to get across is that we see that the alternative lender space, the traditional lender space, they're targeting different markets really. We're looking for the the smaller owners, the mid-sized ship owners. If you're a larger owner and you've got access to traditional banks, at most likely cheap cost of capital, then I think that's definitely something that you should take. However, there's plenty of other owners out there who maybe don't have those relationships, or traditional banks are starting to come to the end of their concentration limits, or owners are looking to finance slightly older tonnage. So I think there's a place for both in the market. And then in terms of flexibility, that's more to do with the way that I think we structure our loans. We tend to work backwards, so we look at our residual risk first, and then look at the cash flows. And we might try and support, we'll always work with our owners, but to try and support perhaps, if they've got contract coverage at the beginning of the facility, maybe slightly front load the repayment profile in order to have those lower break-evens at the back. So yeah, if there is a potential downside, they are better protected. But equally, if the market continues to pick up, then they'll make significant profits.
Thanks, Mike. And I think we just passing the question to Constantinos now as well, and being from the traditional financing perspective. Obviously, there are a lot more options, and with that, there's competition as well, and what your views are on the different sources of capital now. Does that mean more competition? I think we heard from the governor of the central bank saying that the Cypriot banks have lots of liquidity. So is the issue then the cost of fundings and your views on from a banking perspective of the different options available?
From a banking perspective, first of all, the market that we're dealing with is quite big. We tend to focus, this is our banks and our group's policy, to Greek and Cypriot owners, whom we know well, with whom there's an established relationship. I believe that our capacity can absorb, the market is so big that our capacity can absorb enough transactions in order for us to achieve our targets. Of course, we have seen a rise in alternative finance. I believe that it is healthy for a market to provide alternative ways of financing projects. What I would remark is that I believe that the lower cost traditional bank finance will increasingly become focused to more ESG compliant players, which is a trend that is started, and we'll see more of it as we go along. I believe that all different financing levels will coexist, and it's helpful for them to be around, provided they are focused at appropriate terms and ensuring the viability of the clients and borrowers. I believe what we would not like to see, because it is a turbulent period in many respects, is a new shipping crisis.
Thanks, Constantinos. So you touched on a couple of subjects, and I won't take us straight to the ESG side, or actually the threats to shipping, which are always potentially around the corner as well. And just, I think, sticking to almost the deal type and the financing options, I think probably a good topic for Atef, that we've pretty much been the general consensus that actually all asset classes or sectors are attractive, and that there's generally funding available. But I suppose it's two questions in terms of, I suppose, from your perspective and investor perspective, as to how you look to diversify that portfolio. If you see sectors that are more attractive than others. We'll certainly move on to the kind of the eco aspects and fleet modernisation as well. But in terms of the financing and capital available, is it more available in certain sectors than others, or there's consistency in that it's available to the market as a whole?
Yeah. So under Pelagic Partners, also that's how our structure is. We basically have various compartments, and under every compartment there's a different investment strategies. So basically our first fund is focused on more opportunistic investments, which we have done, more sort of older vessel investment. But again, basically the assets we touch is the assets that we understand, the assets that we can add value from the wider group behind us. So having said that, the way we look into investments is basically in a simple matter of what can we bring to the investor and ourselves that can add value, rather than just pinpointing left, right, and center on different categories. So within Fund 1 and Yield Fund, there's investments that are more driven on fixed earnings. So basically, the latest acquisitions that we have under Yield Fund were focused on the tanker, since we have seen that there is a good entry point during end of 2001. We started our tanker exposure up to 2022. Lately, we have taken over also a tanker. Since we believed it was more on a higher cycle, we made sure that we fixed her on a long time charter or relatively long time charter. So based on that, what we're also trying to focus on is to keep the conventional shipping in mind, while also focusing on what's coming next. Therefore, with our latest compartment, Pelagic Wind Fund is basically focused on the wind offshore market. So we have set an order of 6 CSOVs, new builds, that we will start to get delivered in 2025 onwards. This also gives a diversification basically for our investment and our investors from the traditional conventional shipping to what's coming in the future, where we believe that wind offshore will play a significant market, will play a significant role in the change and decarbonization of the world. Now, more on the financing aspect, on the first two funds, since it's more conventional shipping, we have been focused on sort of plain vanilla approach with our traditional lenders supporting us, while as on the Pelagic Wind, since it's more investment into the renewable space, we have been looking into various aspects, whether it's through preferred equity structures with some big institutional investors, or even a potential listing, since we have seen that peers are also listing on similar business models. But that aspect is also depending on what we see happening within the next 12 months within the wind offshore sector in general. So it really depends on the asset class, it really depends on the underlying market, and based on each market, you can then put around the right capital structure for it.
Great, thank you. And I think that brings us quite nicely moving towards the environmental aspects and fleet renewal. But I think I'll let Andreas take us into that topic area as well. But just before moving directly into that, I suppose, ironically, that whilst there is the discussion, there's a lot more capital available. I don't know if it's ironic or not, but there's obviously a lot of deleveraging going on. There's a lot of debt repayments. Perhaps that's repayment of expensive debt and opting for more traditional or more efficient methods. But certainly, for example, in relation to the bond issue, Andreas, for a number of purposes, further acquisitions. I think deleveraging as well, and payments to preferred stockholders as well. So, in terms of the purpose and uses of the capital that's available, do you see that changing? And certainly, there is very much a shift for a lot of companies, moving into the eco ships and fleet renewal.
Well, first of all, I think it's important to have capital available. So it's not just the cost of capital, as the governor said earlier, which is going up, and very soon it will reach quite high levels that we haven't seen since the great financial crisis of 2008. But I also think this will impact the availability of capital, because if an investor can invest at the risk-free rate, which is going to be 5%, and they can get 6%, then the hurdle rate is quite high. So it's going to be very, let's say, more difficult for investors to provide capital to the shipping industry, whether it's the banks or whether it is private equity or other types of alternative capital. With that in mind, I also think that deleveraging is very important, like in any sort of industries. Especially when you've had, let's say, a good time, and when the cost of capital is very low. Because as it is right now, with the cost of capital approaching these very high levels, servicing that debt is going to become absolutely fundamental.
And then just, I suppose, moving slightly more to the purpose aspect and also into the ESG aspect. Certainly, a lot of that resource is being used to invest in more eco-friendly new buildings and those aspects as well. So just sticking with you, Andreas, in terms of, is that likely to be one of the key, I suppose, applications of once that capital is resourced, focusing on that thing?
As a company, we have invested significantly in, let's say, improving our environmental footprint. All of the new builds that are being ordered are fully environmentally compliant. And actually, this is, how shall I say, it's not just a priority, it's an obligation. Because like in other industries, this will clearly impact the shipping industry, and I can very much foresee that either, let's say, institutional investors providing capital to a private equity fund, or for example, from a banking institution, the ESG element is going to be very important in order to provide access to capital to the shipping industry. So yes, absolutely, investing in environmentally friendly ships, let's say going towards net zero by 2050. But let me also just say that it's not just the environmental element of the ESG, but also the social aspect, crew welfare as well. So these are also other elements that are very important in the equation.
If I may add, because Andreas touched on a very important point, as Pelagic, because we have different asset classes, and especially now with the new builds and the CSOP, we can also see the different way or the different how the lenders are basically approaching us. So on the new eco vessels that we are building, which will be one biggest battery pack on board, methanol ready as well, we see much more appetite and interest from lenders and big institutions. Also on the equity raise, basically big institutional investors who currently don't want to hear more about traditional shipping or conventional ships, but are very eager to participate and learn more about the wind offshore part. So this shows that we are moving in that direction, and if we down the path with the conventional ships, big institutional investors will slowly decrease their participation. It will be more private money, smaller family offices, and perhaps a much smaller sector of investors, while as the big pockets will focus on the next generation type of assets, and that we can see already from now, whether it's on the private or public markets.
Great, thanks. And I think I'll take that question back onto Constantinos as well. And you mentioned the ESG focus, and actually a few weeks ago with Milios and the Capital Link team in Athens, the large international banks there were very much in chorus in terms of the environmental focus. At the same time, meaning that there was this competition for those owners that are focusing on environmental and new building. So I won't draw you on the question of margin and basis point, but certainly there was discussion of close to 1% and these types of things because of that focus. But from your perspective, certainly from the banks and the financial institutions, there very much seems to be that focus on the ESG and not just purely the environmental aspects, but across the board.
Yes, absolutely. This is the case. We are now undergoing a transitional period, I would say, where because this is a very fragmented market. There's a lot of stakeholders involved, owners, financiers, charterers, shippers, traders, etc. So every group of stakeholders is trying to is being educated and trying to adapt to these circumstances. On our part, we have not signed off the Poseidon principles. It doesn't fit the model that we operate. But we definitely have as a group set ESG framework and policies. And in ship lending, we are in full compliance with those policies. We have certain clauses and loan agreements. We did not engage, we haven't taken the big step of engaging into green lending in the sense that we would finance geofuel or ammonia or methanol or hydrogen powered vessels. But we focus at this stage on the sustainability aspect. And we do have some sustainability-linked loans, which are based on specific KPIs, which are clearly laid out and agreed with clients. They are measurable and they're achievable. And on this basis, we do offer some benefits to borrowers when they achieve these KPIs.
Right, and I suppose coming slightly full circle, I think one of the interesting presentations before lunch was mentioning that certainly the existing fleet is not going to be replaced anytime soon. So certainly there's a lot of ships in the water that still need capital, still need financing. So I'll bring the question to Michael in terms of you mentioned the word flexible a few times. So from a private equity perspective, does that mean that it's easier to do, I suppose, to some extent, slightly more traditional deals, but also to I guess, be a bit more flexible in the market and, for example, older vessels and what options there may be from a private equity perspective?
Yeah, I think that's absolutely right. I think we have to bear in mind that lots of vessel has been built and that environmental capital has been spent. How do we maximise the yield out of that? And one of the ways is retrofitting, as has been mentioned numerous points throughout the conference today. So we're starting to see a lot of inbound requests while the vessel going to dry dock during the term. Would we be able to apply a portion of the loan towards retrofitting? And that's something that we would definitely support. And I think even if some of the owners don't have standalone codified ESG policies, it's still built into the credit analysis. A more efficient ship is likely to command more in the market, it's likely to have a lower OPEX, it's likely to have a higher residual value, resale value. So it's definitely something that we're supporting.
Well, so far it's all been sounding very positive, so I think it's probably only fair for me to bring the panel back to what they see as the potential threats to financing in the future. I think some of those have been touched upon. I'm hoping the panel isn't going to take us back to the indigestion session that we were dealing with before, but I think I'll start to throw that question open, but actually perhaps either Andreas and Atef, there's been the focus on new buildings, and again one of the comments actually from DNB in Athens was be careful with the new buildings, let's not spoil the market and have lots. I think it seems that we are a little way away from that, and certainly the existing fleet is not going to be replaced overnight. But in that context, what do you see as potential threats? Is it that capital is available now, but it may not be later? Is it cost of funding? What do you see as the potential challenges to the capital that's available at the moment?
So I think the availability of capital is closely linked to the state of the global economy. So I would rate this as the number one threat right now. There is a lot of talk, especially in the US, whether we will have a soft landing or whether there will be, let's say, a policy accident by the US Fed. The discussion is still open, but I think at the current levels of interest, which would surpass 5%, maybe go towards 550. Some people say it might go up to 6%. I think the possibility of a policy mistake are increasing. Should that happen, clearly it will have an impact on the global shipping market as well. So for me, clearly, the state of the global economy is, let's say, an issue, as it is the global geopolitical developments.
Yeah, of course, the global economy is the main driver, of course, for the shipping market. However, we have seen in the last great financial crisis in 2008 to 2009, the demand bounced back relatively fast. So I believe the favorable part we have now, it's working? Yeah, the favorite part we have now is of course the supply side compared to what was back in 2009. All the shipping segments were heavily oversupplied going into the global financial crisis and thereafter. So yes, we might have big uncertainties on the global economy. I see this more like a short-term threat. On the long-term threat, I believe that this time it's not different. It's always been the same if we go back to the history books. So we will spoil the party ourselves if we go back to ordering or overspending. I believe banks are being more flexible now. So with more bank lending, there will be more new orders coming in, and I think on the longer run, this will ruin the party rather than short-term aspects. Last thing about the geopolitical part, I think shipping has always benefited in a way from such events. So as long as we know how to ride the waves of the geopolitical crisis we're currently having, and keep our feet on the ground and not get too carried away with what we have seen, and being able to manage our profits in the right manner rather than just going back and doubling the fleet, then I believe that would be the biggest threat that we have.
I think then, Constantinos, I mean, obviously over the last few years haven't necessarily been easy. You know, things like financial crisis, COVID, war. You know, there's always a lot of challenges out there. I mean, as a bank, you know, you've stuck the course and you've been through a lot of difficult times. What do you see those challenges being from a bank's perspective, and whether it's regulation or other aspects?
The crisis has seen differently from a different angle in shipping, usually than in other sectors. Of course, what's evident in recent years is that the crisis that negatively affected other sectors had a crisis that negatively affected other sectors had ended up very positively for shipping. So if there's a crisis that may affect trading routes, ton miles, we see this as a benefit, of course, for our shipping clients. If there's a crisis that may permanently affect some asset classes which we finance, for instance, that would be a point of concern. So at each point in time, we have to see what we're dealing with and try to have the best possible information and do the best possible analysis on the impact that it will have on our clients, on our lending portfolio, and on the asset classes that we work with. The point of comfort is that as a bank, as I mentioned earlier, we're dealing with the most common asset types. We are not experimenting. We don't have the capacity and capital size to experiment. So I believe by continuing to do our job, to do our proper credit analysis, to adjust our lending parameters and leverage according to the market conditions and the perceived point of the cycle that we are in. I don't see a significant change in the way that we've been working so far, and we've been through a lot. So far, we haven't encountered problems. Our shipping portfolio is probably the healthiest, or one of the healthiest sector portfolios within our bank. So, well, we proceed with caution, no experimentation, and we're looking forward to our clients also adapting to the new conditions, and we will move along with them, thinking of the environmental aspect primarily.
And I suppose in that sense, there's been so many different, diverse challenges over the last decade or so. I suppose a bit like COVID, you start to get a little bit of immunity in the finance market as well. And just before we start to draw to a close, Michael, did you want to touch on the challenges?
I think maybe from the other side, from our investor side, alternative lenders, like look up here, cost of capital becomes one of the most important things. As we have been able to deploy more, our cost of capital has come down. We've been able to pass it on to our clients. It's fantastic. But now with the current software curve, the question remains to be seen as to how our investors will react and whether they will start to demand higher returns. As it currently stands, they've been very supportive of us, and we're still pushing our pricing down, so that's great. But just in terms of future uncertainties, that's something that's on the horizon, and we're aware of.
Great, thank you. And I suppose normally I would draw to close asking the panelists to finish on positive notes and the positive things that they see. But I think probably summarising myself that actually there's a lot more capital, a lot more different perspectives and investment diversity in that capital as well. So I think that's probably the biggest positive that I would take away before I think handing back to our chairman.
Thank you, Jasel. I think you've made a hell of a good job, actually. And I'm very relieved to hear that all the friends on the panel, in fact, without want to use your expression used earlier about causing indigestion. Well, thank God we're not going to have any indigestion, because I never mentioned any of you mention the threat which we're haunted by, the Poseidon principles. That's a bit of another can of worms, where they're trying to bring another improviser in to go and regulate how the ships should be environmentally friendly, which is literally putting too many cooks in the kitchen at the expense of the owner. So I'm quite relieved that I never heard any of you bring that up, so obviously that's not number one on your agenda. On that note, I'd like to thank you very much. Thank you, panelists. And as we said, I think sometimes in banking, I think you guys go by the principle that better the devil you know than the one you don't. Thank you.